The topics in this chapter include key features of bonds, bond valuation, measuring yield, and assessing risk. The key features of a bond include par value, which is also called face amount paid at maturity. Assume $1,000. Coupon interest rate, stated interest rate, multiplied by par value to get dollars of interest, generally fixed. Maturity, years until bond must be repaid. It declines. Issue date, the date when bond was issued. Default risk, the risk that issuer will not make interest or principal payments. Call provision, issuer can refund if rates decline. That helps the issuer but hurts the investor. Therefore, borrowers are willing to pay more and lenders require more on callable bonds. What is a sinking fund? It's a provision to pay off a loan over its life rather than all at maturity. It reduces risk to investor, shortens average maturity, but not good for investors if rates decline after insurance. What is yield to maturity? Yield to maturity is the rate of return earned on a bond held to maturity, also called promised yield. If coupon rate less than required rate of return or yield, bond sells at discount. If coupon rate is greater than yield or the required rate of return, bond sells at a premium. If the yield rises, bond price falls. Semi-annual bonds. Bonds will pay coupon or interest twice a year. If this is the case, multiply years by 2 and get period. Divide the normal rate by 2 to get a periodical rate. Divide annual interest by 2 to get a payment. Excel spreadsheet functions for bond valuation. To get the bond price, we can use price function or yield function in Excel. The interest rate will be the real risk-free rate plus inflation premium plus maturity risk premium plus default risk premium and plus liquidity premium. Bond ratings and bond spread. Bond ratings will be given by typically 3 major bond rating agencies. For example, Moody's, Standard & Poor's, and Fitch. AAA level bond is good bond. The yield will be smaller, for example 2.21% and the spread 0.49%. CCC level bond is a higher risk bond. The yield will be higher, for example 8.3%, and the spread is 6.65%. Other factors that affect bond ratings, such as provisions in the bond contract. For example, secured versus unsecured debt, senior versus subordinate debt, guarantee provisions, sinking fund provisions, and debt maturity. Other factors include earnings stability, regulatory environment, potential product liability, and accounting policies. What is reinvestment rate risk? The risk that cash flows will have to be reinvested in the future at a lower rate, reducing income. The maturity risk premium for long-term bond, higher interest rate risk, lower reinvestment rate risk. For short-term bonds, low interest rate risk, high investment rate risk. Nothing is riskless. Yields on long-term bond usually are greater than on short-term bond, so the maturity risk premium is more affected by interest rate risk than by reinvestment rate risk. Term structure yield curve. Term structure of interest rates is the relationship between interest rates or yields and maturities. A graph of the term structure is called the yield curve. Hypothetical Treasury yield curve. The yield curve typically is upward sloping. As the years to maturity increases, the interest rate increases. Bankruptcy. Two main chapters of Federal Bankruptcy Act. Chapter 11, Reorganization. Chapter 7, Liquidation. Typically, company wants Chapter 11. Creditors may prefer Chapter 7. If the company is liquidated, here is the payment priority. Past due property tax, wages and unpaid benefit contributions, unsecured customer deposits, taxes, unfunded pension liabilities, unsecured creditors, preferred stock, and the last will be the common stockholders.